Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, June 27th, 2021. We're going to have another great show this week. I'll be joined by members of the media, academia, and financial services as we analyze all the news of the week in retirement markets, technology, personal finance, so much more. So sit back, relax, enjoy this episode of BRN Sunday. Let's kick the show off this week with a visit from the Legal Eagles. Joining me now on the line, David Levine, Kevin Walsh, both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, thanks so much for joining us on the program again this morning.
It is good to be here, Jeff. You know, as we wrap up the first half of the year, we are excited to do what is commonly called a clip show. We are going to talk about the highlights of the first half of the year.
A retrospective episode.
There you go, a retrospect. I like it, guys. Look, there's a lot that's happened this year.
Well, actually, Jeff, I have to say, this is a very special episode.
Oh, okay. It's a very special episode. So, Kevin, what's top of mind for you when you look back? We're almost at the midpoint of the year. By the time this airs, it'll be close to the midpoint. Take us back.
Okay, so I'm going to start with the lowest hanging of the low-hanging fruit here. I think the big story of the first half of 2021 is the change of administrations. And I know that, it's an obvious change. Come January 1, we had a Trump presidency. We're now into a Biden presidency. And that's meant some pretty significant, shifts in terms of policymaking decisions. And the first is, it relates to a shift to personnel. And for me, kind of the story of the first half of the year has been EBSA's shift from the Trump administration EBSA, which appeared to be focused on items like, missing participants, and pivoting to an EBSA that is focused on turning back the clock to 2016. And looking at proposals like fiduciary, again, is showing up as something they want to work on, perhaps revisiting some of the exemptions in ways that they did in 2016. And then, personnel changes over there where kind of the big change over there has been that they've appointed a deputy assistant secretary who's now running the show from a political standpoint. Although I think when we get to our second half of the year preview, we'll still be pondering who the head of the agency is going to be, because they still don't have a nominated assistant secretary to head EBSA. So for me, the big story has been the transition from the Trump administration to the Biden administration, and how that has meant in some ways a pivot back to the future, where we're revisiting a lot of the things that we looked at from 2012 to 2016. David, do you want to dive in and take
Kevin,
some of the less low-hanging fruit?
Well, I want to start off by saying, in the year 2000, we will have things like an active Department of Labor. In the year 2000, and I'm doing this in honor of the end of Conan O'Brien's talk show, we will have litigation. And that's my second topic for today. We started out by talking about the DOL being active. Kevin got his gratuitous missing participant line in. I will get in my cybersecurity comment in litigation, but I won't say it now, of course. But at the same time, the litigation continued apace. What have we seen? Well, the great data and security wars continue apace. The questions in litigation about the use of plan data, how it's protected, that has come more to the fore. We've seen a lot more cases coming up about what happens if someone steals my account, breaches of security. And I think that is the big trend, because we could read you a list of all the fee lawsuits that have been filed in the first half, and that would
please
be
do, David. Please do.
That would be
please
really
coming up in the A block, followed by the B, C, D, E, and F block of David reading case names.
Well, as lawyers, we're known for whenever we give litigation presentations, we just talk about a case. So A is for Abernathy, B is for Bueller, and today is my flashback day. So given that, I think the real takeaway from the first half is litigation continues. The plaintiffs are evolving their claims. We will continue to see lawsuits about product, as we've referred to on here, a blender product, where different people play different roles. There's nothing wrong with it. But at the same time, you're seeing the plaintiffs starting to take aim there, and as well as the focus on security and privacy is likely to continue. Now, I have now burned my retrospective time, so I'm going to teleport back to the year 2021 and give it to Mr. Walsh.
I'm going to talk a little about the curious incident of the dog that didn't bark in the first half of 2021, and I think this is a focal point, which is, people have been talking about PEPs for a while. People have been talking about private equity and defined contribution plans for a while. People have been talking about, really adding ESG to 401k plans for a while. And, in the first half of 2021, there's continued to be a lot of discussion about these products. There's been a lot of discussion about how PEPs can create access to create better access to retirement plans for employees of small employers. And, while I still...
Kevin, I got to interrupt you there for one reason. You got to explain the value proposition in an elevator speech. You can't just keep stumbling over the words.
What are you talking about?
You're trying to explain the value of PEPs. PEPs provide collectivization. There's the story.
Okay. So, at bottom, we've got these three things that have really been hyped a little bit, and that the Department of Labor and regulatory changes have suggested are primed to play a greater role in the retirement system. And so far, we've seen relatively limited uptake compared to the expectations. And I think the story there really is just that, COVID, the pandemic, has kind of delayed uptake on actually making changes at the employer level. So I think these are trends that we're going to watch in the second half of the year. But for me, it's been an interesting story to watch, which is that these things haven't taken off yet. David, do you want to jump into the elevator speech again?
Sure, absolutely. The short version is it takes time. Everybody thinks that the retirement industry can move quickly. It's an industry that moves slowly, and for good reason. Because despite what we see in lawsuits, and this is my closeout for this week, despite what we see in lawsuits where the plaintiffs often say, well, you should have changed this then and there. Remember, everything we do in this space is all about process. And it takes time to do a process. Not only in terms of evaluation, but even making sure things work systematically correct. So when people say you should have done this then and there, remember, whether it's something new or something old or something broke or something borrowed, the key is that it does take time. And that is a deep thought by Jack Handy for today.
That is.
So
go ahead, Kevin.
So David, your concern is that if it's something, if it's rushed, if the process isn't there, that it could cause that process really is a key consideration in the retirement system. I think that's a great point to close us out with.
And actually, sometimes people do move quickly, but at the same time, people shouldn't be frustrated because we don't move quickly. People take their time because they're trying to do it right. That's my message.
Yeah, very, very good message, gentlemen. And next week, I'll tease out that we're going to talk about a look forward. There's a lot of legislation, things being considered. I'm really excited about that show. Gentlemen, we're going to have to leave it there. Really appreciate it, you coming on, and wishing you a great rest of your weekend.
Thanks, Jeff. It's always good being on the show.
Bye, guys.
Bye,
Welcome back. Now time to talk tech and consumer products. And joining us on the line, he's lead advisor, executive producer for Seven Investing, talking to Daniel Klein. Dan, so great to talk to you. Thanks so much for joining us on the program this morning.
Good morning, Jeff. Thanks for having me.
Yeah, it's great to always talk about all things tech and consumer products focus. Let's talk about Peloton first, Dan, because they announced that, or not, they did not announce, but it is reported that they're working on a digital heart rate device. Thoughts about that?
Yeah, so on one hand, I think this makes sense. They have such a loyal audience. Why wouldn't they want their audience to wear sort of their wearable and make it optimized for when using a Peloton? The problem with this is I'm going to say that the Peloton audience probably really heavily overlaps with the Apple audience. And I wear an Apple Watch. I can't imagine if I bought a Peloton that I'd want to have to wear like a second wearable. And it sounds like the Peloton wearable device is based around the Peloton, whereas the Apple devices or a Fitbit, if you're a loyalist there, they seem to be tied into your overall everyday health. So on one hand, I see the market. Mm-hmm. On the other, it's like, oh, wait a minute. Like, is this absolutely necessary? So I don't know. I'd rather like a Peloton app tied into my Apple Watch or some sort of joint collaboration like Apple did with Nike a few years ago.
Yeah, I think now that you kind of frame it that way, I think it makes a lot of sense. I'm not sure I want to wear 2, 3, 4 devices, and I'm not sure that I want to be tied to an inanimate object that is going to be sitting in my living room or exercise room or in an exercise room, not following me around. I think, people obviously like the Peloton brand, and they like the concept, but I agree with you. I'm not sure that it makes a lot of sense to create a wearable, but I guess we'll have to see.
Yeah, I mean, look, the wearables market is incredibly dominated by Apple, and they made some announcements last week that they're looking at things like being able to check your insulin levels and take your blood pressure and all sorts of other things. And there's a giant leap to becoming an actual medical device versus what it is now, where it's sort of like an anecdotal medical device. So it is a big difference between telling me, someone who isn't diabetic, what my blood sugar is, and telling someone who actually is diabetic, hey, you need to take some insulin. That requires FDA approvals. It's a whole different thing. You also have to prove you're as good or better than the current standard of care. That's a big leap. But I actually expect that Apple, at least as call it a medical assistant, is going to get there. And they're going to be able to tell you things like hydration and blood sugar. And it might all be for non-medical reasons, like, hey, Dan, you need some water, you need a snack, whatever it is. But that gives it a big lead. And I can't imagine that Peloton's going to catch up. So this feels to me like, I don't know, work on like some Peloton clothing or something, or expanding out to something like Mirror or something like Tonal, where there's more products in the Peloton line. I think this one's a bit of a stretch.
Yeah, or improve your cybersecurity protections, right, Dan? Because I think Pelotons were hacked. I think people were hacking in. I don't know who these people were, but they were watching people exercise, which I don't really think that maybe that's just for fun, but I don't see that as being too incredibly interesting.
Yeah, I think as a country we've kind of gotten used to the hack. I think the last time we really freaked out about a hack was either Target or Experian. I'm not sure I want someone watching me exercise, but I'm also not sure why someone would want to. I guess I exercise in a public place, so if you wanted to come to my gym and watch me, I guess you could.
Yeah, and I guess more broadly speaking, the Peloton costs what, $49.99 a month for the service. I guess hacking would give you some level of access to maybe some of the account information. I agree. Maybe watching people in unflattering poses or things probably doesn't make a lot of sense to me. Maybe they could catch you and do some type of ransomware type of fraud that way. But it just seems odd to me.
I have a full makeup team that attends to me while I'm exercising, so I wouldn't be worried. But for the average person, that still doesn't seem like that big a deal. This isn't a shower cam. Like, it might be a little embarrassing that you're on the Peloton and sweating and grunting or whatever, but I don't know. It doesn't feel like, if someone wants to sell videos of me on a treadmill, good luck. Go ahead.
Yeah. Dan, let's shift gears, talk a little about streaming, never far from anything that you and I talk about. Viacom, CBS, and Roku shares up, Comcast sinking a little bit. Does this have more to do with the linear versus streaming, or is this something else?
So there's a rumor out there, and Comcast, I think, was sort of talking out loud, that Comcast wants to at least consider buying Roku. Now, forget that this is a terrible deal for Roku, because the business of Roku is about being independent. The second they tie themselves to one company, one piece of content, they have some real problems. But let's pretend this was possible. This is a really tough deal, because the reality is that Roku has about 25% the market cap of Comcast. So that is a very heavy acquisition. Comcast also has a fair amount of debt. So this is a situation where it would have to look more like a separate company. The only way this would make sense to me is if Comcast spun off its NBC Universal assets, its television, its film studio, its theme parks, combined it in a company with Roku that had nothing to do with the cable company, and then let Roku's people run it. That would look a lot like the Discovery Time Warner deal, where the smaller company, Discovery, ended up, they own less of the company, but their management is going to be in charge. I don't see this as very likely. The second possibility here is that they floated the idea that Peacock Network only has under 10 million subscribers. That's a disaster. The amount of money they've put into this, the amount of promotion they've done, maybe the Olympics will save it. I highly doubt it. they've put out the idea of maybe they would team up with CBS Viacom. I don't see this as an acquisition because the U.S. government regulatory agencies are not going to allow one company to own two networks. And I don't see anybody either side wanting to sell their network. But I could see a streaming partnership where you have some combination of Paramount Plus and Peacock. Peakamount, I have no idea what that would be called. But the problem is we've seen in the streaming world that Disney has risen to a place of prominence very quickly because they have top-tier content. Comcast has some top-tier film content, but Paramount has very little. So if you're combining, what are you getting as Comcast? You're adding Star Trek, you're adding The Good Fight. These aren't A-list shows. So I don't think this deal makes sense for anybody. And aggregating a bunch of like second-tier content doesn't add up to, 10 Star Treks don't equal one Mandalorian. So this doesn't make any sense to me.
Well, I think it's an acknowledgement. I'll just give you my uneducated analysis. I think it's probably an acknowledgement about the consolidation, right? That we've talked about, that we're seeing in the streaming industry. There's a lot of players out there. I think it's also an acknowledgement that content is king, and maybe the content that's being produced, as we've talked about before, isn't the greatest. And I think people are binging, but they're not binging like they were. I think they're over binged. They're binged out, whatever the right word is there. So I think it's kind of trying to figure out how to keep an audience, because if you keep an audience, you can attract sponsors and advertisers and earn income.
Yeah, if I was Comcast, I'd focus on top tier franchises. So the first thing I would do is they're paying WWE about $2 billion every 5 years between their Peacock deal and their USA Television deal. I'd sit down with WWE and find out if 6 million, 8 billion, whatever the number is, billion, not million, gets the job done, and buy WWE. They've clearly been packaging the company for a potential sale. I think Fox would be interested. I think Comcast should be interested. And then all of a sudden you've locked up your cable programming. You can eventually take the rights back from Fox. And then you've got 2 nights of programming that are reliable. You've got all the network content. And then I would look at other standalone things that I could buy. Is that a massive bid to take over UFC and take them back private? I think that's possible. Is that really going after sports rights as they come up? That's the one thing they have. But Peacock has the problem that is very similar to HBO Max, is that if you're a current Comcast subscriber, you get Peacock for free, and a lot of people aren't taking them up on that offer. Now, will the Olympics, maybe push some of that? Maybe. But if you're not Disney, if you're not Netflix, if you're not Amazon Prime, which people just have sort of reflexively, I don't think anyone's watching. And we've seen with Apple, you can have very premier television. The morning show got all the publicity, and I don't think 1 million people have watched it. So it is a very, very tough market to crack.
Dan, do you remember the movie The Cable Guy with Jim Carrey?
I do. That's the movie that ended Jim Carrey's career.
Yeah, well, do you remember at the end of the movie when they knock out the satellite and someone, the TVs go out and someone looks on their nightstand and they see a book? I got to tell you, I've been reading a lot more books, whether it's in audiobook form or tablet form or physical form, and I can find great content there. There's so many classics that you can read. Look, I just think we're coming to a point where there's just too much, and it's hard to kind of filter through. I still think the user experience not that good on a lot of these platforms to find content.
No, it's a problem. If it's not a Disney series that I know is in a universe that I'm really into, I'm not watching it until it's been guaranteed for a second season. There's a lot of things that I've been burned on, and now that Netflix is so willing to cancel shows and not give you resolution, I watched the first 2 seasons of Glow. Haven't seen season 3 because they're not giving you a season 4, and it's just going to end just with no tie-up. And I understand the pandemic did some of that, but you mentioned binging. I'll say I'm really enjoying the episodic nature of what Disney is doing. I watched Loki episode 3 last night, and I don't know if you're caught up there, but wow, is that series powerful? And every episode gets a breakdown on multiple entertainment sites, and there's a lot of things I'm missing, and I'll probably watch it again tonight. I'm very much enjoying having that like appointment television. And I think that's a lesson to be learned for everybody else. That said, there aren't that many intellectual properties that are going to guarantee you watch it. I'm not sure that Comcast or Paramount or whoever it is can say, okay, we're going to release this new show and everyone has to watch it at some point. So, this is very much a winner's going to win. Everybody else is going to struggle.
Yeah, well, I'm kind of binged out personally, but I'm waiting. I'll wait for the Mandalorian to come back whenever that's going to come back. Checked out season 2, 3. I think we're on season 3, right?
Season 3.
Yeah. Well, Dan, always a pleasure chatting with you. I love the variety of topics we can cover in 10 or 15 minutes. Have a great rest of your weekend, and we'll talk to you again very soon.
I'll see you next week. Bye.
Welcome back. Now time to talk a little real estate. Joining us on the line, he is the real estate reporter for Dow Jones Market Watch. Talking about Jacob Passy. Jacob, so great to have you back. Hope you had a great restful vacation, some good time off, and thanks for joining us this morning.
Yeah, glad to be here, rested and recharged.
Absolutely, and here we are. Summer's officially here. What's top of mind this week when you look at the world of real estate?
So first things first, and you and I have talked a lot about this, but the eviction moratorium nationwide for renters, it was set to expire next week at the end of June, but the Biden administration announced on Thursday that they are going to be extending it. But they basically said this is the last time. They kind of are telegraphing to renters and landlords and the whole industry that this is, one last extension. And they're doing it in that way for a couple reasons. One, there's been, and you and I have talked about this, there's been a lot of money, billions of dollars appropriated by Congress for emergency rental assistance to help get people back on their feet, help pay some of that back rent off so that they're not owing as much to their landlords, get, landlords back in a better financial position. But a lot of that money hasn't been distributed yet. There's been roadblocks, slow going. There's all the effort that the states and localities across the country that are distributing the funds have to go to set up the program. So that all has taken time. And the Biden administration wanted to make sure that there was enough time to get at that money to everyone. But they also kind of wanted to signal that, the end is coming, so that, state and local lawmakers who are doing that work will do it as soon as possible. And yeah, it's be a change. And so, I'm now, and the Biden administration, everyone kind of across the country involved in real estate, we're all looking to what is going to happen next. Once the moratorium does end at the national level, what is the next step?
So I'm sure you thought that through, and that would be my next question: is have you thought about, or in talking with members of the industry, have you talked about what we could expect as the moratorium eventually will end? It has to end, and then we find some level of equilibrium in the real estate market.
Totally. So the Biden administration is really thinking about this. State and local lawmakers are thinking about this. One thing that is in the works, it appears, is that a lot of parts of the country, states, cities are setting up eviction diversion programs, and these can take different forms. But basically, ways of getting potential evictions out of the kind of judicial pipeline. Because there's two big concerns. One, we don't want lots of people to go homeless, and there's still millions of Americans who are behind on rent, who might otherwise be facing eviction at the end of the moratorium. And obviously, we don't want anyone on this, out of a home. We want everyone to be housed safely. It's good for their health. It's good for the economy. But at the same time, landlords do need, to be paid. And, there are, those financial considerations to be made. But also state and local leaders are concerned about a major backlog. I mean, a lot of the court proceedings that are happening across the country are still being done virtually. There's still, considerations to be made in terms of capacity at courthouses for how many people can be in the building, things like that. And what all that means is that, kind of like we've seen with airlines, one of the folks I spoke with in the rental industry compared it to what we've seen with airlines, how they're, having challenges. And I also write about travel, so I've been focusing on this too. The American Airlines had to cancel tons of flights this summer proactively because they were realizing they didn't necessarily have the capacity to serve all those flights. And that's kind of the same situation right now in the judicial system. There's kind of this, sense that there are going to be thousands of evictions that are going to be filed once that moratorium ends, but our court systems are not necessarily going to be able to handle that sudden influx of cases. So the Biden administration, state leaders, local leaders are trying to create programs that will help tenants and landlords basically sort out their issues in a non-trial courtroom setting. Maybe that's, making sure that they get legal assistance, get financial assistance, figure out other ways of, restructuring payments and stuff like that, so that we can get people back on their feet and also avoid these massive backlogs of cases that, aren't good for anyone. So, that's, and then there's other considerations. The rental industry, I've spoken with folks who are on more of the rental home side rather than the apartment side. And a big issue there has been a lot of, smaller mom and pop landlords who only own, one or two rental properties have decided, this past year was so stressful, they want out. So they've been selling their homes, but not all of those homes are being bought by people who are going to keep them as rentals. A lot of those homes are being bought by people who are going to just live in them themselves because of all the issues we've had in terms of the low supply of homes for sale.
Right.
So that leads to the rental stock overall is dwindling, and that's going to drive prices up. And so there was a great quote from one of the folks I spoke with who said, we went into the pandemic with an affordability crisis, and we could come out of the pandemic with a housing affordability disaster. Like this whole situation, it's not just about diverting evictions and trying to avoid evictions. It's also looking, bigger picture. Are we losing housing stock? So those are the concerns right now. And the solutions aren't clear cut, and we're going to have to see how those shape up over the next, few months.
Yeah, I think it's going to take, anytime you do something like this and you kind of restart the process, there's equilibrium. I think economists refer to it as that, and it's about finding the natural level of things, but you also don't want to displace people. As you said, there's a lot of human considerations that have to be part of that. It can't just be a 0-1 financial economic consideration. Jacob, just quickly changing gears, we've got a couple minutes left, but wanted to gauge your perspective on mortgage rates that have now jumped above 3% for the first time since April.
Yeah, it's notable, and it kind of shows how the rate of inflation that we're seeing across the economy is playing into what we're seeing in the housing market. Economists have kind of been expecting mortgage rates to go up for a while now, and they finally did cross that 3% threshold, as has been anticipated. It's not entirely clear where they'll go from here. I think the general consensus is that they'll go up, but how quickly they go up it remains to be seen, and some of that will depend on if the Federal Reserve does decide to get more hawkish and roll back their programs in terms of supporting the economy and keeping rates low. Then rates will jump up higher more quickly. If that doesn't happen, then maybe they won't jump up more quickly. Either way, it's going to have an effect on homeowners and home buyers alike. There was really interesting data from Zillow about how very few homeowners actually did refinance their mortgage this past year. It was based on a survey they did, and they kind of said a lot of homeowners just decided not to refinance to lock in that lower rate. So there's a lot of people who could still benefit from refinancing, but that opportunity could be going away quickly depending on how fast rates rise higher. And then on the home buyer side of things, prices are still rising higher. We do see sales volumes falling, but but that's more just a reflection of the fact that there's just so little inventory out there to buy. that naturally there just can't be that many sales. And the more and more this keeps happening, if prices keep rising and rates keep rising, a lot of people are going to get priced out of the market. And, it's not clear what happens next. Probably won't be bad for home builders. They'll probably keep building new homes. But, we could see a slowdown in sales activity that's even more pronounced from what we've seen in recent months if a lot of buyers decide to exit the market because they just can't afford it.
And to what you were talking about earlier, displacement, if people are selling the rental properties to people who want to live with them, I guess that helps with some of that capacity. But what do you do about people who want to rent, and where are they going to go? Because they need to find a place to live if they're displaced.
Right, exactly. And then you look to a lot of people in the rental industry say we need to look to the home builders. They need to be building more rental housing. And that's probably true. I mean, that's certainly true. We do need just more housing overall built in this country. But, any time that a home builder devotes resources to building rental housing, that means they're not building housing meant for owner occupants. And, they can only, be going in so many directions at once. So it's a tough call. And I think that, this housing affordability situation is not going to be a fleeting moment. As much as people think that the housing market might crash, at the end of the day, if there's just not a lot of stuff to sell or to rent out, prices are going to probably remain pretty elevated. And so we'll have to look to whether, policymakers do anything to make the situation easier for Americans across the country.
This is all part of that reopening process, it sounds like, Jacob. I guess more to come. We're not going to know anything today, tomorrow, maybe even a few months. So we'll keep checking in with you and trying to learn as much as we can. Jacob Passy, always a pleasure chatting with you. Thanks so much for joining us, and have a great rest of your weekend.
You too. Take care. Bye-bye.
Welcome back. Now we're going to end the show talking about markets, and joining us on the line, he's the host of Morning Trade Live and Markets on the Close. I'm talking about TD Ameritrade Network's Oliver Rennick. Oliver, great to have you back on. Thanks so much for joining us on the program this morning.
Thank you, Jeff. Appreciate it as always.
Yeah, it's always great catching up with you and getting your unique analysis, I will say, yours and the TD Ameritrade Network's unique analysis on the market. So let's talk about I don't know where you want to start. Do you want to talk Bitcoin? Do you want to talk the broader market?
Sure.
Well, you tell us what you want to talk about.
Well, I think the most important thing is that stocks continue to climb sluggishly but steadily, and this week picked up a little bit of momentum thanks to some pretty big days, both from tech and the NASDAQ, and a few days of small caps doing nicely as well. And the kind of trade-off, constant back and forth, the idea that investors can count on one being higher on any given day pretty much has put, I think, a good bit of confidence into this market, even after we saw a good bit of volatility after the Fed last week. So this was an important week for sure to see that stock investors are still convinced this is a regime that's good for them. Mm-hmm. My coverage has been generally pretty cautious the last couple months, basically since February, actually, just cautioning that the speed of the upside should be limited and the degree of upside remains limited. So that approach and that framework went a little bit challenged this week as we saw a lot of buying in stocks after the Fed. But the case remains that there is still some really big shifts that are kind of happening across a few different asset classes outside of stocks. And that's basically bonds and the dollar. And as you mentioned, for crypto too, frankly, which I do think is important. So I don't think we're necessarily resolved yet in some tension. And the tension that I see in the market is a spike in the U.S. dollar, which has really only come for two reasons the past year. The dollar has really only spiked if inflation is moving upwards or if there's a risk-off event. And part of that strength was very clear at the beginning of the year when the U.S. was kind of first out of the gate from COVID. Our inflation story was building. The dollar was very strong. And then over the last several months, that faded. and then it popped again last week, and it didn't really reverse much this week. It softened up a little bit, the dollar, but it held a good degree of its elevation that it found post-Fed, and that's really important to me because everyone basically thinks the dollar is going to keep going lower. But the Federal Reserve told us they are prepared to act against inflation and prepared to potentially move up the rate hike timeline. And that had a big effect across markets except for stocks. And that to me is just a little bit odd. You had a big move in the dollar. You had a very dramatic move in bonds. The yield curve flattened out. Long bond yields dropped. Short-term bonds, their yield popped. That is not necessarily something that is stock bullish because it doesn't necessarily imply something great about the economy. Oftentimes that curve flattening happens as a result of growth expectations being tamped down on the long end. So this is a long answer to the question, but basically a few big things moved after the Fed in very different ways. The dollar spiked, which is not really part of the playbook, and the bond curve flattened in a way that was not really part of anybody's playbook either. So you have these pretty extreme, shocking moves, and stocks have managed to absorb it. So that either means the stock market is incredibly powerful or it's just not paying attention to the macro themes that are changing. And I do think they are changing. And I think one potential interpretation is that they're changing because the Fed's regime will have to be more aggressive going forward than people thought. So it's kind of odd that stocks have been so powerful throughout that, which is why I continue to kind of cover things from a cautious perspective.
Oliver, let me ask you about this. We're getting some news out of Washington. We're recording this at 1 p.m. Eastern time about a infrastructure deal for about $1 trillion. That just seems like chump change, right? But what does that have any implication, or what implication might that mean for the stock market? This so-called quasi infrastructure deal.
So that's pretty interesting too, because when that headline came out this week, it didn't really move the needle much, and that's either speaks to how just kind of inundated we've been with stimulus that $1 trillion doesn't really like move the needle much, just under $1 trillion. But also, I think it was first portrayed as this bipartisan deal, and when you hear bipartisan, you think that that's a certainty in terms of it becoming law. But then the complications that maybe there's another bill that has to go with it. It's not as popular with one side of the aisle, and so it might have more difficulty getting through. I don't really know. That's not really my expertise, but my general takeaway from it, and I think the market's takeaway was that, unless there's a high probability of something getting passed, then it may not move the needle much. But of course, if something does arrive, and I think we generally should expect something to arrive for the next wave of spending, it's hard to believe that just nothing's going to happen after so many promises. So assuming something does arrive, $1 trillion, $2 trillion, it generally should fall into the camp as being probably growth positive, unless there's some really wacky stuff in it. So most likely growth positive and most likely inflationary, just from a perspective of if our baseline right now is for an improving economy and reflation themes, adding on things that could accelerate the economy even more should also accelerate reflation. So, but many believe that the market is not worried about this inflation right now because of the way bonds have rallied so much. But there's another interpretation of that actually there could be enough inflation to where it's impinging the potential growth for the economy, and that's why people are buying bonds. So that's one interpretation that doesn't get a lot of attention.
Let's talk a little bit about the cryptocurrency volatility. I think we saw Bitcoin kind of go up or down, now pop back up. I think it was up at 34,000. What's this mean broadly speaking for crypto, and where does that stand as an asset class? Is it still risky, quote unquote risky?
Oh, absolutely. I mean, this is the whole reason why this is such a big deal. And I've described it as narrative destruction of Bitcoin. That to some degree could be fatal, frankly. Bitcoin's always going to be around because there is a value to it, that you can transfer money without a third party and a central party taking part. But that hasn't really been strangely enough, the story for Bitcoin in its great run from $1,000 to almost 70,000. What's been behind that is this idea that it will have utility beyond that relatively limited portion of the population that needs a new type of permissionless, exchange of value. The story that's allowed Bitcoin to run wild is the story that it is an alternative to gold, that it can function in a portfolio, that it is necessary as part of a portfolio, that it is either, people said it was money at one point, but none of these things work now, and they're basically being proven false. The volatility that we saw over the past 3 months is as bad as any in Bitcoin's history. So after a decade plus, it has not made any progress on the volatility front, which basically means it's impossible to be a useful means of exchange. And then the gold thing was always this story that was impossible to disprove because we've never really had inflation. We've never really known what an inflation hedge will do. And we've never really had a backdrop for policy from the Federal Reserve side that's anything less than accommodative. So you could kind of just watch prices go up and assign whatever stories you wanted to. But now you actually have to prove what these stories are and if they're connected to reality. What we're finding out is there are certain things in the stock market that are doing very well as we move towards an inflationary and possibly tighter policy regime. And we're finding out which assets don't do well. And right now, Bitcoin looks like basically the worst performing risk asset. There are other high growth risky assets in the stock market that are in bear markets right now that are still down 20% off their highs, but Bitcoin is down 50 plus as we speak. So obviously it's doing nothing like gold. Gold is actually kind of doing traditionally what it should relative to real interest rates. And yes, gold has had a little bit of a rough go too, but it's nothing similar to Bitcoin. So that story's kind of gone. Volatility is there. So the money utility of Bitcoin is gone. And now, in my view, we will continue to basically unwind price to when those narratives began. And that's probably a long ways away. So Bitcoin's looking really, really bad right now. So yes, it's very risky.
I was going to say, I feel really sad for gold and fiat currency because they have, ever since going off the gold standard in 71 and now, the replacement, quote unquote, by cryptocurrency, those two assets get a really bad name, but it sounds like they may be kind of pinging back and resurging. So,
oh yeah, fiat wins the day.
Yeah,
sure.
Absolutely. Well, Oliver Rennick, it is a pleasure, and folks should certainly check out Oliver on the TD Ameritrade Network. Like I said, Markets on the Close and Morning Trade Live. It's the place to be early in the morning and when the market closes up. Have a great rest of the weekend, and we'll talk to you again soon, Oliver.
Thanks a lot. See you.
Bye. And that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow, this time for BRN AM. We've got another set of great guests. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.